You're sitting with a mortgage calculator open in one tab and a rent listing open in another. Everyone in your life has told you the same thing for years. Buying builds wealth. Renting throws money away. It's not really a debate in most conversations. It's just assumed. But the number sitting in front of you right now doesn't match that assumption. The mortgage payment alone is already higher than your rent, and that's before taxes, insurance, or anything else gets added on top of it. Something doesn't add up here, and you're not entirely sure what. Here's what almost nobody runs before making this exact decision. The real math, in full, using real 2026 numbers. Not the advice everyone repeats, and not the assumption baked into it either. The advice you've heard your entire life didn't come out of nowhere, and it wasn't invented to mislead anyone. For decades, it actually made real, calculable sense. Mortgage rates sat near historic lows for years on end. A 3% rate on a home meant your monthly payment could genuinely land close to what rent would cost for a comparable property in the same neighborhood. Home prices grew steadily during that stretch, not explosively, and the math, run honestly and in full, usually favored buying, especially the longer someone planned to actually stay in the home. That's simply not the specific environment you're making this particular decision in right now, whether or not anyone around you has updated their advice to reflect it. As of early August 2026, the average interest rate on a 30-year fixed mortgage sits around 6.7%, according to Freddie Mac's weekly survey data. That's more than double what it was during the low-rate years the older advice was originally built around. The exact number moves week to week, sometimes even day to day, but it's been sitting in the mid to high 6% range for months now, showing no real sign of dipping back down toward anything close to 3. Here's what that shift actually does to the math, in concrete terms. At 3%, a $400,000 mortgage might cost you around $1,700 a month in principal and interest alone. At 6.7%, that same loan costs closer to $2,600 a month before taxes or insurance ever even enter the picture. That's not a small difference sitting quietly and harmlessly in the background somewhere. That's an extra $900 a month, every single month, for as long as you hold the loan. Money that has to come from somewhere specific in your budget, whether or not the advice you grew up hearing ever accounted for it at all. This is exactly why the old advice doesn't automatically transfer to right now, no matter how confidently and how often people still repeat it in casual conversation. It wasn't wrong when people originally said it years ago. It was accurate for a completely different set of numbers entirely, built around a fundamentally different rate environment than the one sitting in front of you today. And numbers this dramatically different change the entire calculation sitting underneath the advice, even when the advice itself never got updated to reflect that meaningful shift. So if buying still genuinely makes sense for you, specifically in 2026, it has to make sense at these current real numbers, not the ones your parents or older siblings were working with when they made their own decision years or decades earlier. Most people, when they first picture the real total cost of buying a home, picture exactly one single number: the mortgage payment. That's the specific mistake this section exists to fix, in real detail. Start with the home itself, using the current sourced figures available right now. The average home value in the United States sits around $370,320 as of mid-2026, according to Zillow's ongoing tracking data. Put 20% down on that specific figure, and you're financing roughly $296,000 through a mortgage. At the current average rate of 6.7% on a standard 30-year fixed loan, the principal and interest alone runs close to $1,910 a month, all by itself, before anything else even gets added on top. That's just the mortgage payment amount itself. It's not remotely the real, complete total cost of actually owning this home over time. Property taxes come next in the calculation. and they vary quite significantly depending on the specific location. But a reasonable national estimate runs around 1% of the home's total value annually. On a $370,000 home, that works out to roughly $3,700 a year, or about $310 a month, added directly onto the mortgage payment in most standard loan arrangements you'll encounter. Homeowners insurance adds another genuine cost that's climbed noticeably in recent years, especially in regions prone to severe weather events and natural disasters. A typical monthly premium lands somewhere in the range of $150 to $200 for a home at this specific price point, though it varies quite widely depending on the exact state and its particular local risk factors involved. Then there's genuine maintenance and repair costs, which most first-time buyers underestimate the most, often quite significantly, sometimes to their own real surprise later on. The commonly used rule of thumb among real estate professionals is 1 to 2% of the home's value per year. On a $370,000 home, that's $3,700 to $7,400 annually, or roughly $310 to $620 a month. Quietly set aside for the roof that eventually needs replacing, the water heater that eventually fails, and the countless smaller repairs that never once show up on a mortgage statement but arrive anyway, usually at the worst possible time imaginable. Closing costs deserve a real mention here too, even though they represent a one-time expense rather than an ongoing monthly one. Buying a home typically comes with real closing costs running 2 to 5% of the total purchase price. On a $370,000 home, that's $7,400 to $18,500 paid entirely upfront, on top of the down payment itself, before you've even spent one single night in the place you just bought. Add all of this together carefully, and the mortgage payment you originally calculated stops looking anything like the real, complete cost of ownership. Instead of $1,910 a month, the actual real total monthly cost of owning this specific home lands closer to $2,700 to $3,000 a month. Once taxes, insurance, and a genuinely realistic maintenance reserve are all properly factored into the final math. That's the actual real number that should get compared directly to rent in any honest, complete analysis of this decision. Not the mortgage payment in isolation, which is the exact comparison most people mistakenly run without ever fully realizing how incomplete that comparison really is. Now flip to the other side of this exact comparison and run the exact same honest, complete accounting against it. The national median rent sits somewhere between $1,400 and $1,550 a month as of mid-2026, depending on which specific tracking source and unit size you happen to be looking at. Apartment List's national median lands at $1,388 a month, while HUD's fair market rent figures for a comparable two-bedroom unit run closer to $1,550. Either way, whichever figure you use, the number sits well below the $2,700 to $3,000 real total cost of ownership calculated in the previous section, even before anything else about the comparison gets factored in at all. But rent alone isn't the entire picture on the renting side either, and stopping the comparison there would repeat the exact same incomplete mistake this video has been trying to correct all along. Renters typically pay renter's insurance too, which runs quite modestly, usually somewhere around $15 to $30 a month, depending on the coverage level and specific location chosen. There's no property tax to worry about, no maintenance reserve to set aside, no closing costs to pay up front, and no personal responsibility for a failed water heater or a roof that suddenly needs replacing. Those particular ongoing costs simply belong to someone else, specifically the landlord who owns the property in question. Here's the piece almost nobody actually accounts for when they compare these two numbers casually, and it's arguably the single most important figure in this entire section. Buying requires a real down payment. In the earlier example, roughly $74,000 on a $370,000 home, sitting there up front before the mortgage even begins. That money doesn't have to sit locked away inside a house, untouched for decades. If it gets invested instead, in a diversified portfolio averaging something like 7 to 8% annually over time, that $74,000 alone could realistically grow into real, meaningful money over 5, 10, or 15 years, entirely separate from anything happening with rent or a mortgage payment during that same stretch. This is the real opportunity cost that almost never makes it into casual, everyday conversations about renting versus buying, even though it sits at the very center of the actual math involved. Every single dollar tied up permanently in a down payment is a dollar that isn't compounding anywhere else in the meantime, quietly working in the background. Renting doesn't just cost meaningfully less on a monthly basis in this specific scenario. It also frees up real capital that can be doing something else entirely productive with itself, provided the person renting actually invests that difference consistently rather than simply spending it on a slightly nicer lifestyle instead. That last condition matters enormously, more than almost any single number covered so far in this video. And it's exactly where this comparison stops being a simple, tidy math problem and starts depending on something much harder to precisely calculate: genuine, sustained personal discipline over a long stretch of time. Everything covered so far in this entire video has been steadily building toward one specific number, and it's the number that actually settles this decision far more reliably than any single monthly payment comparison ever could on its own. It's called the price-to-rent ratio, and it's a real, well-established metric used consistently throughout real estate and financial analysis circles, not something invented specifically for this video. The formula itself is refreshingly quite simple. Take the median home price in a given area and divide it by the annual rent for a directly comparable property. Whatever specific number comes out the other side tells you in one single clean figure whether that specific market currently favors buying or renting overall. Here's how to actually read that number once you have it in front of you. A ratio below 15 generally reliably signals that buying is the financially favorable move in that specific local market. Home prices are low enough relative to rent that ownership tends to make sense reasonably quickly, without needing years and years to fully pay off. A ratio sitting between 15 and 20 falls into genuinely ambiguous territory, where the answer depends heavily on other factors covered elsewhere in this video, like exactly how long you plan to actually stay in the home. Above 20 specifically, and renting starts looking financially stronger on paper, at least from a purely cash flow perspective alone. Above 25 specifically, which several major coastal and metro markets currently sit above, renting is almost certainly the stronger financial move by a genuinely meaningful margin. Using the current national figures introduced earlier in this video as a rough national illustration, an average home value of $370,320 divided by an annual rent of roughly $16,680 using the higher $1,390 monthly rent figure works out to a ratio of about 22. That places the national picture, in aggregate, closer to renting favorable territory than to buying favorable territory overall. Though this national average blends together dramatically different local markets that could realistically sit on either side of that exact line entirely. This is exactly why renting versus buying doesn't actually have one single national answer, no matter how many people online try to confidently give it one anyway. San Jose currently sits at an extremely high price-to-rent ratio near 55, according to recent housing market analysis, an extreme case where renting saves dramatically more money every single month compared to buying. Pittsburgh, by very stark contrast, sits close to a ratio where the two housing options cost roughly the exact same amount overall each month. Most other cities in the country fall somewhere in between those two extremes, and your own specific city's ratio matters enormously more to your actual decision than any single national average ever realistically could. This single number won't tell you absolutely everything about your own personal decision, and it was genuinely never meant to on its own. It doesn't account for exactly how long you plan to stay, or whether you genuinely invest the difference consistently if you chose to rent instead. But it's the fastest, most concrete way to get an honest first read on which direction your specific local market currently leans, before layering in the more personal factors that come next in this video. There's a phrase that gets repeated constantly and confidently throughout this entire debate: renting is throwing money away. It's one of the most common claims in all of personal finance, and it's also one of the most genuinely misleading, because it treats every single housing decision as if it happens over the exact same fixed timeline, regardless of the actual circumstances involved. Time horizon changes this entire underlying calculation more dramatically than almost any other single variable covered so far in this video. Closing costs alone, that same $7,400 to $18,500 upfront figure calculated earlier in this video, need real, actual time to genuinely pay themselves off. If you buy a home and then sell it 2 years later, those transaction costs get spread across just 24 short months, which is a genuinely brutal amount of expense to absorb, relative to how little real equity you've actually built up in that short window. Add in typical selling costs of yet another 6 to 8% when it eventually comes time to sell, and a genuinely short stay can easily leave a buyer meaningfully worse off financially than if they had simply rented the entire time instead. Stretch that same exact decision out to 5 full years instead, and the math starts shifting meaningfully in the buyer's favor. Some real, tangible equity has built up in the home by that point. Some genuine appreciation has likely occurred already in most reasonably healthy markets. The upfront costs are now spread across 60 full months of ownership instead of just 24 short ones, making each individual month's share of that original burden considerably lighter than it was back at the 2-year mark. Stretch it out to 15 years instead, and the picture changes again quite significantly, this time much more dramatically than the earlier jump from 2 years to 5. By that 15-year point, a meaningful and steadily growing share of each monthly mortgage payment is going toward principal rather than interest, quite unlike the earlier years of that same loan. The home has likely appreciated substantially over that much longer stretch of time, assuming a reasonably normal, healthy market throughout. And the mortgage payment itself, if it's a standard fixed-rate loan locked in from the start, hasn't moved even slightly in 15 full years, while rent in that same local market has almost certainly climbed considerably higher than it was back when the original decision was first made. This is exactly why renting is throwing money away doesn't actually hold up at all as a blanket universal statement that applies equally to everyone in every situation. It depends entirely, almost completely, on how long someone actually ends up staying in the home they bought. A 5-year stay and a 15-year stay are not remotely the same financial decision in practice, even when both scenarios technically start from the exact same numbers on day one, with the exact same home and the exact same mortgage terms locked in from the beginning. None of this is theoretical or purely hypothetical at all. There's a real, published, on-record account that shows exactly how this entire comparison plays out when someone actually runs the numbers honestly in their own real life. Peter Daisy, writing for the personal finance publication Do, described buying his very first place back in 2019. A 2-bedroom condo, a reasonable mortgage payment, a genuinely walkable neighborhood. At the time, his mortgage payment landed close to what comparable rent would have cost him in that same area. It felt, in his own words, like a completely obvious decision to make. But writing again in 2026, 7 years later, he was refreshingly direct about something most people tend to avoid saying out loud. If he were facing that exact same choice today, the answer wouldn't be merely as clear-cut anymore. To illustrate exactly why, he ran a representative example using current 2026 figures: a $400,000 home, 20% down, a 6.5% mortgage rate. The total real cost of ownership on a home like that lands around $3,200 to $3,600 a month, once taxes, insurance, and maintenance are properly included in the math. A comparable rental, in that same illustrative scenario, runs closer to $2,200 to $2,500 a month instead. That specific gap is exactly the kind of gap this entire video has been carefully unpacking, piece by piece, from the very beginning. Here's what makes his honest reflection genuinely worth including in this particular video. He doesn't regret buying his own condo at all. His equity has grown steadily over the years, and he openly acknowledges that he got genuinely lucky with timing, locking in a low rate before rates eventually surged upward, and buying into a specific market that happened to appreciate faster than the broader national average. But he's equally direct and honest that plain luck isn't a repeatable strategy anyone should actually count on when making their own decision. His conclusion, stated quite plainly in his own words afterward, if he were genuinely starting from scratch today, in 2026, he'd run every single number carefully and completely, compare it honestly against renting and investing the difference instead, and make the decision based on real math rather than emotion or cultural pressure from family and friends around him. That's not a rejection of buying as a concept in general, and it was never meant to be read that way by anyone. It's a rejection of deciding on complete autopilot in either direction, without actually running the specific numbers that genuinely apply to right now, in 2026, rather than blindly relying on the numbers that applied years earlier when the original advice was first formed. So let's go back, one final time, to that mortgage calculator open in one browser tab, and the rent listing sitting open in another right next to it. There isn't one single universal answer waiting quietly inside those two open browser tabs, and there never really was one to begin with. There never was, and no video, no calculator, and no confident stranger's loud opinion online was ever going to hand you one for free, no matter how many times they insisted otherwise. But there is a genuinely calculable answer specific to your exact situation, built entirely from everything covered throughout this video, from start to finish. Start with the price-to-rent ratio in your own actual city, not the broad national average that blends dozens of dramatically different local markets together into one misleading, overly simplified number. Factor in the full, real total cost of ownership as well, not just the mortgage payment sitting on the screen in front of you right now. Account honestly and completely for the opportunity cost of your specific down payment, wherever that particular money would otherwise be sitting and growing. And be brutally realistic with yourself about how long you're actually likely to stay in the home, rather than the number you'd secretly prefer to imagine instead. Run those 4 specific factors together in your own case, and the vague, exhausting cultural debate, buying versus renting, endlessly framed as some kind of moral character test about who's being financially smart and who isn't, disappears completely from the conversation entirely. What's left instead is simply a math problem, plain and clean. Nothing more dramatic or philosophical than that at all. Math problems have real, findable answers, even messy ones. They're not always the specific answers people expect going into the calculation. And they're not always permanent decisions either, since rates and prices genuinely shift over time and can change the entire calculation again later on, sometimes within just a few years. But right now, today, using real current 2026 numbers specific to your own exact situation, there genuinely is a version of this decision that makes considerably more financial sense than the other one does. That's the specific number genuinely worth actually finding for yourself in your own real life, not the one everyone else online insists is universally, permanently correct for absolutely everybody, in every city, at every single point in time. So here's the honest, practical homework if you actually want to do it right now. Pull up your own city's median home price and median rent side by side. Divide the first number by 12 times the second, and you'll have your own local price-to-rent ratio. not a national average that doesn't actually reflect where you personally live and work. Add up the full, real, complete cost of ownership as well, not just the mortgage payment alone. Be genuinely honest with yourself about how long you'd realistically stay in the home. And decide, honestly and ahead of time, whether you'd actually invest the difference consistently if you chose to rent instead. Because that single answer changes everything else about this entire comparison. This isn't about proving definitively that buying is inherently smarter, or proving that renting is inherently smarter than the other option. It's about refusing to let a slogan built for a completely different rate environment quietly make a decision this large on your behalf, without you ever once checking whether it still genuinely applies to your own life. This channel exists to keep running the real, honest numbers on the financial advice most people repeat confidently, without ever once double-checking whether it's still accurate. If today's video helped you see this specific decision more clearly than before, subscribing means you genuinely won't miss the next one in this series. Before you go, I want to know honestly, where does your own math actually point right now, specifically? Toward renting? Toward buying? Or somewhere genuinely too close to call without gathering a bit more information first? Drop it in the comments section below, along with your specific city if you're genuinely comfortable sharing it publicly. I read every single one, and this particular conversation is far from finished.